The largest risk factor that we see out in the world today is global deleveraging, a process that is occurring in the private sector and shifting over to the public sector. Second risk factor that we see is solvency risk, and that is predominantly sovereign solvency, but very closely related to bank capital issues as well. There are a number of other risk factors that are probably not as intense at this point in time. One is relative demographic shift. Another relative regulatory shift, which are important. Another one that it has been building for a number of years and is likely to be very important in the near future is central bank balance sheets and the exposure of assets and currencies around the world to central bank balance sheets. There are other risk factors, but I believe those are the ones I would say that advisors really should focus on and think about how changes in those risks or developments in those various areas might affect their aggregate portfolio performance. Most investment portfolios over the years have been built in a silo capacity. In other words, an equity silo, a bond silo, an alternative silo. And that's fine, except it doesn't account for influences that cut across those categories. The second thing is that they've tended to focus a lot on bottom-up managers that are able to add value by looking at the individual securities within each of those silos. I think what's really important in the current environment is for advisors to think about how these managers will come together in a way that diversifies across the macro themes that they see. And then two, and very importantly, identify managers who actually explicitly take these factors into consideration across the silos, across the various asset classes, to try to manage on a top-down basis the exposures that ultimately may come from those risk factors.